Here's the question nobody asks correctly. What actually separates a rich person from a family office? It's not the number in the account. It's not the house or the watch, or whether the coat is real shearling or a Target knockoff. It's whether the money has started managing itself yet, or whether you're still the one doing every single push. So let's define the thing properly, because most people get this wrong immediately. A family office is not a bank. It's not a wealth management firm with a nicer lobby. It's a private company built by one family for one family that exists to handle everything money touches once money gets complicated enough to need full-time staff. Investments, taxes, estate planning, sometimes even the house payroll and the jet scheduling. Think of it less like a service you buy and more like a company you build, the same way you'd build any other business, except the product is your own family's future. Here's the part that surprises people. At level 1 from $0 to roughly $10 million, you don't need any of that. Not a sliver of it. If you've got $2 million or even $8 million and someone's trying to sell you a family office, they're not selling you a solution. They're selling you a costume, the financial equivalent of the $2,140 sneakers built to look distressed on purpose. Expensive, impressive, and solving a problem you don't have yet. At this level, the actual toolkit is almost embarrassingly simple. A Vanguard or Fidelity brokerage account. Low-cost index funds, the same S&P 500 fund your dentist owns. Maybe a Roth IRA you max out every January 1st like it's a religious holiday. A basic will, maybe a revocable trust if you've got kids in a house, drafted by a solid estate attorney you'll talk to twice, maybe 3 times total. That's the whole operation. No committees, no quarterly investment reviews. No one flying in from Geneva to discuss your asset allocation over lunch. This is the DIY years, and DIY isn't a downgrade here, it's actually correct. You are your own CIO, your own compliance department, your own everything, because at this size, the fees a full-service advisor would charge, typically 1% of assets a year, can quietly eat more of your future than any market downturn will. On $2 million, that's $20,000 a year, every year, often for advice you could execute yourself in 20 minutes on a Tuesday night with an index fund and some patience. But there's one hire that actually matters here, and it's not glamorous at all. It's a good CPA, not the seasonal chain a few blocks from your apartment. An actual accountant who understands your specific situation, whether that's a small business, RSUs vesting from a startup, or rental property you picked up in your late 20s. People underestimate this hire constantly because it doesn't feel like wealth building. It feels like paperwork. But the entrepreneur who structures an S-corp correctly in year 1 can legitimately save tens of thousands in self-employment tax over a decade. The person who doesn't even know what a Section 179 deduction is just handed the IRS money they were never required to give away. A good CPA isn't an expense at this level. It's often the single highest return investment available to you, quietly worth more than whatever stock you're agonizing over on your phone at midnight. Now here's where people at this stage torch money in a completely different way, and it's the mirror image of not hiring a CPA. They overpay for advice they don't need yet. You've seen it. Someone hits $3 million, usually from selling a business or a big liquidity event, and within a month they've got a wealth manager charging 1.25%, a life insurance policy they don't understand sold to them as an investment vehicle, and a financial plan 60 pages long forecasting their net worth in the year 2061. None of it is inherently a scam. Most of it just doesn't apply yet. It's Priya's $58,000 tractor that doesn't run. It looks like sophistication, it performs seriousness. But at $3 million, the honest math almost always favors the boring, cheap, unglamorous option, because complexity you don't need is still a cost, even when it comes wrapped in a nice office and a firm handshake. The real shift at level 1 isn't structural at all. It's mental. It's the moment you stop thinking like someone who earns money and start thinking like someone who manages it. Earning money is a sprint mentality. Get the raise, land the client, close the deal, check the account, repeat. Managing money is a completely different posture. It's asking what happens to this dollar over the next 20 years, not what it buys you this weekend. It's the difference between checking your portfolio daily out of anxiety and checking it quarterly out of discipline. Most people never make this shift because nothing forces them to. The accounts just don't get complicated enough yet to demand it. And this is exactly why the millionaire next door with $4 million in index funds and a 15-year-old Camry often ends up wealthier at 60 than the person who made triple his income and spent level 1, optimizing nothing but their lifestyle. But something changes, and it changes fast once you cross $10 million. The DIY playbook that worked perfectly at $2 million, at $5 million, even at $9 million, starts cracking under its own weight. The tax situations multiply, the estate questions get sharper. Suddenly, one CPA and one index fund isn't a strategy anymore, it's a liability. And that's the moment the entire architecture of how you handle money has to change, whether you're ready for it or not. So what actually happens at $10 million? The math stops being simple. You cross that line, and suddenly your CPA, the same one who saved you six figures structuring your S-Corp, starts returning your calls a little slower. Not because they got worse at their job, because your questions changed. You're not asking how to deduct a home office anymore. You're asking what happens to your estate if you die next Tuesday, whether your LLC actually protects anything, and why your accountant keeps mentioning something called a grantor trust like you're supposed to already know what that is. This is level 2, and it's the point where DIY quietly becomes malpractice. Not because you got lazy, because the surface area of your money outgrew what one smart generalist could hold in their head. The first real shift is staffing, and it's smaller than people expect. You're not hiring a building full of analysts. You're hiring 3 specific people, usually part-time, usually fractional, because full-time doesn't make sense yet at this size. A fractional CFO, someone who might work with 6 other families like yours, who spends 4 hours a month actually looking at your cash flow instead of you eyeballing a spreadsheet at midnight. An estate attorney, a real one, not the guy who drafted your will for $600 back when your only asset was a townhouse and a 401k. And a wealth manager, but a different flavor than the one you correctly avoided at level 1. This one isn't selling you a life insurance policy disguised as an investment. This one is coordinating with your CPA and your attorney, so the 3 of them are actually looking at the same picture instead of 3 different slices of it. Here's what nobody tells you about this stage. The job title that matters most isn't any of those 3. It's the 4th hire, the one that feels almost embarrassingly unglamorous. A bookkeeper, a family administrator, someone whose entire job is tracking the fact that you now own a rental property in Austin, a stake in your cousin's brewery, index funds at 3 different brokerages, and a 529 plan you funded once in 2019 and forgot existed. At $2 million, you could hold all of that in your head. At $30 million, you can't, and pretending you still can is how 6-figure mistakes happen quietly, in the gap between accounts nobody's actually reconciling. Now let's talk about the structures, because this is where the real money either gets protected or gets bled out slowly over a decade without you ever noticing the wound. Trusts stop being optional paperwork and start being architecture. A revocable trust that made sense at $4 million to avoid probate now needs siblings. Irrevocable trusts to move appreciating assets outside your taxable estate before they appreciate further. Maybe a spousal lifetime access trust if you're married, letting you gift assets out of your estate while your spouse can technically still access them if things go sideways. LLCs multiply too, not because you're trying to look sophisticated, but because putting the Austin rental, the brewery stake, and your brokerage overflow into separate entities means a lawsuit against one doesn't touch the others. It's the financial version of not keeping all your animals in one barn. One fire shouldn't take the whole herd. Tax strategy stops being an April conversation and becomes a year-round one. Entity structuring, deciding whether income routes through an S-Corp, a partnership, or stays personal, changes based on what kind of income you're generating and how much of it. Charitable vehicles start entering the conversation, donor-advised funds, sometimes a private foundation once you're deep enough into this range, letting you take a deduction now while deciding the actual giving later. And timing of income, when you recognize a gain, when you exercise an option, when you sell the rental, starts mattering in a way it never did at $3 million, because at this size, a badly timed year can push you into a bracket that costs you tens of thousands of dollars for a decision that took you 30 seconds to make. This is exactly why multifamily offices exist and why this bracket is their entire business model. A single-family office, the kind with a dedicated CIO and in-house staff, doesn't make financial sense until you're well past $100 million. The overhead alone would eat your returns alive. But a multifamily office lets 15 or 20 families in the $10 to $100 million range share one team, one CFO, one set of systems, splitting the cost the same way you'd split a private chef with 3 other households instead of hiring your own for a kitchen you use twice a week. It's not a downgrade from a real family office. For this bracket, it's the correct architecture, the boring, unglamorous, right-sized version of the thing everyone assumes only exists for billionaires. And this is exactly the kind of structuring most people get catastrophically wrong when they try to shortcut it, which brings me to something worth mentioning right here, because it's genuinely relevant to everything we just walked through. The book this video is based on breaks down these exact structures: trust selection, entity layering, the charitable vehicles that actually make sense at each bracket, in far more depth than 11 minutes allows. It's discounted this week only, links in the description, and if you're anywhere near this stage, or you're advising someone who is, it's the difference between guessing at this architecture and actually understanding why it's built the way it is. Because here's the mistake that shows up over and over at this level, and it's expensive in a way that doesn't announce itself immediately. Someone sets up a trust in the wrong state, or structures an entity based on advice from a generalist attorney who does 20 different kinds of law instead of one, and it looks fine for years. Nothing breaks. No alarm goes off. Then a liquidity event happens, a business sale, an inheritance, a piece of real estate finally selling after a decade, and suddenly the trust doesn't do what everyone assumed it did. Assets that should have been protected are exposed. Income that should have been shielded gets taxed at the top rate because the entity was never structured to route it correctly in the first place. By the time anyone notices, you're not looking at a small fix. You're looking at years, sometimes a full decade of tax savings that quietly evaporated because the foundation was wrong from the start, and nobody checked the foundation until the house was already built on top of it. That's the real lesson of level 2. It's not about having more money than level 1. It's about having money complicated enough that the cost of getting the structure wrong finally exceeds the cost of hiring people who know how to get it right. And once you cross $100 million, even this foundation, the trusts, the fractional team, the multifamily office sharing your CFO with 14 other families, starts cracking under its own weight the exact same way the DIY playbook did back at 10. Somewhere past $100 million, the multifamily office stops fitting. Not dramatically, not with a single bad quarter that blows everything up. It just starts feeling like a rental house you've outgrown. The rooms are technically big enough, but you're tripping over things that used to fit fine. Your CFO, the one you share with 14 other families, takes 3 days to get back to you on a deal that closes in 48 hours. Your reporting comes quarterly when you need to see cash positions weekly. And the private equity fund your multifamily office got you into as a courtesy allocation, the $2 million slice of a $400 million fund, starts to feel less like access and more like a seat at the kids' table. This is level 3, and it has a name in the industry that sounds almost bureaucratic for something this expensive: going institutional. Here's what actually happens. You stop renting infrastructure and start owning it. The single-family office is born right here, usually somewhere between $100 and $150 million, because that's roughly the point where the math finally flips. Below that line, paying for your own dedicated team costs more than the returns it generates. Above it, not having your own team starts costing you more than the salaries would. So you hire a chief investment officer, a real one, full-time, 6 figures plus carry or performance incentives, someone who used to run a book at a hedge fund or manage allocations inside an endowment, and whose entire job now is thinking about your money 8 hours a day instead of splitting attention across 20 other households. You bring accounting in-house, not a fractional bookkeeper checking in 4 hours a month, but a controller who reconciles positions daily across entities you've lost count of. And you hire legal counsel, actual in-house counsel, because by this point you're not calling an outside firm every time a term sheet lands on your desk. You have someone on payroll whose job is to read term sheets before breakfast. This is the moment the family office stops being a service you buy and starts being a company you run. And once you're running a company, you need the things every company needs, whether you wanted them or not. You need an investment team, not just a CIO sitting alone with a Bloomberg terminal, but analysts underneath him sourcing direct deals, doing diligence on private equity opportunities, evaluating alternatives that never would have crossed your desk at level 2 because nobody bothers showing a $2 million check writer a direct co-investment in a Series C. At this size, they show you. A founder raising $60 million for a logistics company doesn't just want your capital, he wants your operating experience, your network, your ability to write a $5 million check without asking permission from a fund manager 3 states away. That's a different kind of relationship than buying into someone else's fund. It's slower to build, and it requires people whose full-time job is building it. You also need governance, and this is the part that sounds boring until you watch a family skip it and lose $40 million in 18 months because nobody skipped it. An investment committee, usually the principal, the CIO, maybe an outside advisor or two, meeting on a real cadence, not whenever someone feels like it, reviewing every deal against a written policy instead of a gut feeling. Risk policies that actually say, in writing, how much of the portfolio can sit in illiquid alternatives before it becomes a problem if you need cash fast. Reporting systems, real software, not a shared spreadsheet three people are editing at once, tracking performance across public markets, private holdings, real estate, and whatever direct deals the team sourced last quarter. None of this existed at level 2, because at level 2 the portfolio was simple enough to hold loosely. At level 3, loose is how you lose 8 figures without anyone noticing until the annual review. And here's the part that makes all of this worth the overhead. Crossing into institutional status doesn't just change your staff. It changes what the world is willing to show you. Co-investments open up, the kind where a private equity firm running a $2 billion fund lets you invest directly alongside them in a single deal. No fund fee, no carry stacking on top of carry, just you and the GP in the same position. Venture allocations that used to require a $250,000 minimum in a fund of funds now come as direct access to actual venture partnerships, the kind that call you before the round is even public, because your name on the cap table means something to the next round of investors. Real estate syndications shift from being something you buy into passively to something you help structure, sometimes as the lead investor bringing in other family offices behind you. You're not a customer anymore. You're a counterparty. But none of this comes cheap, and this is where the math gets strange in a way that catches almost everyone off guard. Costs don't scale linearly here. They scale in steps, and each step is steeper than the last. At level 2, going from a $10 million portfolio to a $50 million portfolio might mean your fractional CFO bills a few more hours a month. At level 3, going from $120 to $200 million might mean an entirely new hire, a second analyst, a compliance function you didn't need before, a bigger office lease because the team that fit in a spare room now needs actual desks. The overhead of running a single-family office typically runs somewhere between 50 and 100 basis points of assets annually once you count salaries, technology, legal, and office costs. On $150 million, that's not a rounding error. That's $750,000 to $1.5 million a year just to keep the lights on before a single investment decision gets made. And this is exactly where the hidden risk of this level lives. Empire building. It sneaks in disguised as ambition. You hire the CIO, and the CIO wants a deputy. The deputy wants 2 analysts. The analysts need a data subscription that costs $80,000 a year. Someone decides the office needs its own compliance officer, even though you don't manage outside money. 18 months in, you're running a 15-person operation that costs $3 million a year to support a $180 million portfolio, and the returns aren't materially better than what a lean 5-person team could have delivered. The staff grew to justify its own existence, not because the portfolio demanded it. This is the single most common way families torch capital at this level, not through bad investments, but through building an organization that outpaces the wealth it exists to serve. The families who get level 3 right stay deliberately small for as long as they can, hiring only when the portfolio's complexity forces the hire, not when ego or comparison to some other family office does. Because somewhere past $300 million, the whole structure changes shape again, and if you've overbuilt here, you walk into that next level carrying weight you never needed to carry. Somewhere past $300 million, the conversation in the office stops being only about returns and starts being about generations. Not in a soft, greeting card way, in a contractual way. Because at this size, the biggest risk to the family's wealth isn't a bad trade anymore. It's a bad handoff. This is level 4, and the industry calls it the full family office, which sounds like a formality until you realize what actually gets built here. You're not just managing money at this size, you're managing a family as an institution that has to survive people leaving it, whether through succession, divorce, or death without the wealth leaving with them. So the first thing that shows up is something most families have never heard of until they need it, a family constitution. Not a metaphor. An actual document, often 30 or 40 pages, drafted with outside advisors who specialize in exactly this, laying out how decisions get made when the founder isn't in the room anymore, who sits on the investment committee in the next generation, how disputes between siblings get resolved before they turn into litigation. What happens if a grandchild wants to cash out their share and start a business versus one who wants to stay in the family enterprise for the next 30 years? Families skip this document constantly because it feels premature, like buying a headstone while you're still healthy. Then the founder has a stroke at 68 with no succession plan written down, and 3 adult children who've never once discussed money with each other suddenly have to agree on everything, unanimously, while grieving. Next-gen education becomes formal here too, not a lecture at Thanksgiving about not spending too much, but actual structured programs. Kids in their 20s sitting through sessions on reading a balance sheet, understanding what a capital call is, learning why the family owns a stake in a mid-sized manufacturing company in Ohio nobody's ever visited. Some families send the next generation through week-long immersion programs built specifically for heirs of this size wealth, run by firms whose entire business model is preparing 25-year-olds to eventually sit on a board they didn't build. Because the wealth doesn't just need protecting from markets. It needs protecting from the next generation's own inexperience, and inexperience is patient. It waits until the founder is gone to show up. The second shift at this level is that the family office stops being a place that allocates to deals and becomes a place that does deals. At $150 million, you were writing checks alongside a private equity firm. At $400 million, you're running private equity operations in-house. Your team sources a company directly, does its own diligence, negotiates its own terms, sits on the board, and manages the operating relationship for the next 5 to 7 years until exit. You're not paying someone else 2 and 20 to do this anymore. You're building the muscle yourself, because at this size, the fee drag from outside managers on a portfolio this large starts to look less like a cost and more like a wound. A family office running $450 million with even a modest allocation to traditional PE funds can be handing over $4 to $6 million a year in fees alone. Bring even a portion of that in-house, and you're not just saving the fee, you're building an operating capability that compounds on itself, deal after deal, decade after decade. Then there's philanthropy, which at earlier levels looked like writing a check to a cause someone cared about. At this level, it becomes infrastructure. A private foundation with its own board, its own mandatory 5% annual distribution requirement, its own program officer whose full-time job is finding organizations worth funding and measuring whether the funding actually worked. Impact investing shows up too, capital deployed not just to make a return, but to make a return and move a specific outcome. Clean water infrastructure, affordable housing, education access, structured with the same rigor as any other investment in the portfolio, because at this size, giving money away badly is almost as damaging to a family's legacy as losing it. And then there's the part nobody puts on the website. Reputation and privacy become a full-time job. At $50 million, nobody's building a dossier on your family. At $500 million, your name shows up in property records, in SEC filings if you're on any boards, in the annual report of the foundation, in a local news story about the manufacturing plant your PE arm just acquired. The family office starts managing what's public and what isn't with the same seriousness it manages the balance sheet. Trusts get structured specifically to keep names off deed records. Media training happens before a founder ever gives an interview. Someone on staff is now responsible, formally, for knowing exactly what a stranger with an internet connection could find out about this family in an afternoon. Because at this size, visibility isn't a lifestyle choice anymore. It's a security question. So look at where this journey actually went. It started with a spreadsheet and a single advisor at $2 million, maybe $5 million, you doing the DIY years, learning the vocabulary as you went. It built real infrastructure between $10 and $100 million, a team instead of a person, a strategy instead of instinct. It went institutional past $100 million, a CIO, in-house counsel, governance that didn't exist before because it didn't need to. And now, past $300 million, it becomes something closer to a private institution than a bank account, a structure built to outlive the person who built it. Every level up removed a little more improvisation and replaced it with structure. And every family that skipped a structure at one level paid for it, often years later, in a currency that had nothing to do with market returns. Here's the mistake that shows up most at this exact level, and it's rarely the investments. It's the missing constitution. Families who build the CIO, the in-house PE team, the foundation, everything except the governance document that says what happens when the founder isn't the one making the final call anymore. One family we researched didn't discover the gap until 14 months after the founder's death. 3 siblings, no written succession plan, and a legal bill north of $6 million before the dispute even reached mediation. That entire cost, the fracture, the money, the relationships, traces back to a document that takes maybe 60 days to draft properly at this level. We break down exactly how that failure happens and 14 other expensive mistakes just like it in the book linked in the description.